Okay, let us talk about debits and credits. Okay, so debits and credits are used for what we call creating journal entries. And journal entries are made in what we call a journal. If we were to go back 60, 70 years ago, before technology was used in the world of accounting was done by hand. Okay, and so one book accountants would use is what's called a journal. Okay? And a journal is just a chronological listing of all the transactions that took place. Another book they would use is called the ledger. And the ledger would be essentially a place where we keep track of every account the company is using to keep their financial records for. So if you think about your balance sheet, every line item on a balance sheet, cash, accounts receivable, inventory, land, building, equipment, accounts payable, notes payable, common stock, retained earnings, all the balance sheet accounts, and then all your income statement accounts, all your revenue accounts, all your expense accounts like advertising expense, rent expense, depreciation expense. All those line items would also be a separate account. So the general ledger, you can think of this book where each page is a separate account. So probably page 1 would be the cash account. And anytime there's a transaction deal with cash, we would record it in the ledger. Page 2 might be accounts receivable. Page 3 might be inventory. Okay? So the way the process works, when a transaction occurs, we record it in a journal entry, and then we copy, or in the language of accounting, we post it from the journal to the ledger. So now let's go back. Let's talk about recording a journal entry, and we'll do it by making up what are known as T accounts. Okay. So, but first, let's write the accounting equation. So the accounting equation, assets equals liabilities plus shareholders' equity. Okay. And we can say this is the left side of the equation equals right side. And the accounting equation always has to be in balance. Assets must always equal liabilities plus shareholders' equity. Okay. So what we'll do, we'll put what is known as a T account on each side of this accounting equation. So this T account would represent an asset. So what we mean by T account is an account. So this could be cash, accounts receivable, inventory. That's what we write up top. Okay. Then we sort of draw a letter T underneath it. So the name of the account, then the letter T underneath it. We call that T account. And the reason we have this line going down the middle is to split it into left side and right side. Okay. And then we give these names. We don't call them left side, right side. That's where the language of accounting comes in. We call the left side of an account debit side, and we call the right side of an account the credit side. Then over here, we have assets, and over here we'll have a T account for, I'll just write L and SE for liabilities and shareholders' equity. Same thing. The left side of this account is a debit. The right side of this account is a credit. So that's all debit and credit means. Debit means to do something to the left side of an account. Credit means to do something to the right side of the account. And what those debits and credits actually do to the account depends whether it's an asset or a liability / stockholders' equity account. Okay. So the way this is going to work, we say we increase an account based on what side of the accounting equation it's on. Okay. So notice assets are on the left side of the accounting equation. So that means we increase an asset on the left side of the account, which is the debit side. Okay. So to increase an asset, we debit it. Conceptually, once you know that one, if all you want to memorize at this point in time is that to increase an asset, we debit the account. These other three possibilities that we see here, we should be able to logically think through them. Okay? So staying with the asset T account, if we know we want to increase that account, we debit it. Well, to decrease it, we would do the exact opposite. The opposite of a debit is a credit. So a credit to an asset would decrease that account. We come over to the other side of the account equation, the right side of the account equation. Liabilities and shareholders' equity are on the right side of the account equation. So that's why we're going to focus on the right side of the account to increase it. So again, as we said before, we're going to increase accounts based on what side of the account equation they're on. Assets are on the left side of the account equation, so that's increased with the debit. Liabilities and shareholders' equity are on the right side of the account equation, so we increase those with a credit. And then logically following, to decrease, we would do the exact opposite. The opposite of a credit is a debit. Okay. So that's how debits and credits work. Like I said, if you just memorize this one right here, that to increase an asset, we debit it. These other three possibilities should follow, right? So if we're increasing a debit with an asset, if we're increasing an asset with a debit, we do the exact opposite, decrease it. And then we go over to the other side of the account equation, the right side, it flips around. A debit to a liability or stockholders' equity account would decrease it, whereas a credit to a liability or stockholders' equity account would credit it. Okay. So that's a good starting point. So we'll stop there with this one. Okay. And there's the basics of how we record debits and credits in terms of T accounts.